Good evening, everyone. It's time again for today's market analysis and tracking. I believe many of you benefited yesterday, especially from the Ethereum trade we shared. Those following the channel know that when there's a clear signal, we act on it. When there isn't, we stay patient and observe. Over the past 2 days, the war situation has not created a war profit opportunity for Bitcoin. Instead, when major geopolitical conflicts erupt, they inevitably impact price and create volatility. And volatility, that's our source of profit. Looking at the current situation, Bitcoin's so-called safe haven attribute has not been particularly evident during this round of geopolitical tension. I've always reminded everyone not to overstate Bitcoin's safe haven narrative. In reality, it behaves more like a high-growth speculative instrument. From my perspective and from the perspective of many on Wall Street, Bitcoin does have core value. I personally place great importance on that intrinsic value. However, to many on Wall Street, Bitcoin is primarily viewed as a high-growth, consensus-driven speculative asset. In their eyes, it originally had no fundamental value. In fact, at the beginning, many of them dismissed it entirely, considering it nothing more than air without backing. But as consensus around Bitcoin deepened, even they couldn't fully explain why that consensus kept strengthening. You have to understand that in this world, there are broadly two types of people. Those who sit down and build things writing code and developing technology, and those who allocate capital and invest. The capital allocators may not fully understand the technical mechanics, but they observe that the engineers and developers strongly believe in it. Rather than deeply researching it themselves, they conclude, if so many capable builders believe in this, then we'll treat it as a high-growth speculative asset. When market sentiment is strong, they allocate capital and speculate. When market conditions deteriorate, they quickly discard what they don't fully understand. That's why, when risk emerges, Bitcoin does not behave like a safe haven. Instead, it often becomes one of the first assets to be sold. The core reason is that the native crypto investor base simply does not have enough capital power compared to Wall Street. The difference in scale is enormous. So if Wall Street decides that an asset should be reduced or abandoned, native crypto investors have little ability to counterbalance that flow. That's the reality behind the current dynamic. That said, I believe there will come a time when Wall Street fully understands Bitcoin's value. As the longest-running public ledger in human history, as a truly immutable and decentralized blockchain, and as a form of digital gold, its long-term fundamental value will eventually become more apparent. That's the fundamental perspective I want to share with you. Alright, today let's review the short position we discussed yesterday. Let's start with ETH. For Ethereum, yesterday we said that after price touched the high around 2060, if you saw an upper wick forming there, you could open a short position. If you didn't catch it the first time, then on a rebound, once you saw another upper wick, you could short again. Yesterday, I personally entered, although not exactly at 2060, I opened my position at 2037. At the moment, it's showing a small profit. Now, during this process, as we mentioned yesterday, price may form a contraction pattern. It may form a contraction. What does contraction mean? It means the lows are getting higher, one higher than the previous low, and the highs are getting lower, one lower than the previous high. Higher lows, lower highs, that forms a converging triangle, a symmetrical triangle. When a symmetrical triangle completes, it eventually chooses a direction. How does it choose? Here's a method. A symmetrical triangle is different from an ascending or descending triangle. The final breakout direction of a symmetrical triangle usually follows the original trend. And what was our original direction? Downward. The original trend was downward. So after this contraction completes, the probability is that it continues downward. In most cases, it follows the prior trend rather than reversing. Unless in the spot market you suddenly see a sharp surge in volume, a major spike in trading activity or turnover. In that case, a reversal could occur. But right now, we are not seeing that signal. So the higher probability scenario is that after this contraction completes, price moves lower. At minimum, our strategy remains the same. 4 words we emphasized yesterday: short on rallies. So in this market, the approach is short on rallies. But what if the market doesn't give you a good rally entry? What if it doesn't give you an ideal shorting point? As we just discussed, once the contraction completes, if direction confirms downward. For example, if this low is broken, then I can open a small position there. If the next low is also broken, I can add to the position there. If I open at the break of this low and price breaks down but then reverses upward, that's fine. I can set my stop loss at the previous upper high within the contraction, for example, at that level, and stop out partially. You could cut 50% or 100%, then reassess. These are basic risk management techniques. Personally, my risk tolerance is a bit higher. In a situation where the direction is relatively clear, once this level breaks, this level breaks, I would open the heaviest allocation within my segmented position structure. For example, I might open a 10% position there. Then I wait. If price retraces back up to this area, I might cut 50% there. If it reaches the higher level, I may exit fully. That's roughly the structure. If price has already broken below this level, in my view, the probability of it returning all the way back up there is relatively low. So overall, the strategy remains short on rallies. Now, stepping back to the daily chart on the daily time frame, price is still consolidating. However, the consolidation range is gradually expanding. What does that imply? It suggests that the market is preparing for a new directional decision. Once that direction becomes clear, we can establish spot positions accordingly. And at the same time, open defensive positions in the futures market, preparing for the next bull cycle that could potentially turn you into a millionaire or even a multimillionaire. Everyone I know who has made real money in crypto, and not just in crypto, but also in traditional equities, built their positions at clearly defined cycle lows during bear markets. I don't encourage people on this channel to go all in recklessly. However, when the market truly reaches an exceptional long-term accumulation zone, I do support building heavy spot positions. The key is timing, and right now we are not there yet. In fact, there may still be another extended leg down ahead. Why do I keep emphasizing Ethereum? Because Ethereum rises fast and it falls just as fast. The pullbacks are aggressive. It has already retraced very quickly back to the starting point of the previous bear market, essentially revisiting that prior structural base. If we mark out this discussion range, you'll see how critical it is. Price has almost returned to the lows of the previous cycle, even approaching levels from 2 cycles ago. Now, here's what I want to stress. Ethereum's long-term value is still substantial. There's a saying you may have heard: crypto isn't designed for humans, it's designed for AI. That brings us to a recently discussed development, the x402 protocol introduced by Coinbase. Going back to the early days of the HTTP protocol, there was a concept called payment required. The idea was simple. When an AI system interacts with a service, it can query whether payment is required for access or for a response. If payment is required, it executes the payment automatically. In Ethereum's recent upgrades, elements like payment state tracking, transaction records, reputation systems, and verification mechanisms are being increasingly integrated into the network's infrastructure. Ethereum's development pace has been accelerating. Yes, the Ethereum Foundation's recent personnel changes created some uncertainty and shook confidence for certain investors. But Vitalik has stepped forward and continues pushing protocol development forward. That ongoing technical progress is visible. Because of that, I remain confident in Ethereum's long-term outlook. From an investment standpoint, Ethereum has value. The question now is whether it drops to 1,550 or even further, possibly toward 1,230. We don't know the exact bottom yet, but what is clear is that the downside is not finished. The market has not fully flushed out yet. This final leg down may not be extremely large in magnitude, but under current conditions, it is still not appropriate to go long. The reason we cannot go long right now is simple. Liquidity conditions have not improved. The broader geopolitical environment remains unstable, and the Federal Reserve's policy stance is still restrictive. Overall, the macro backdrop is unfavorable. This is not just night, it's the darkest part of the night. Think of it as 2 or 3 a.m. There is still a long stretch before dawn. That said, while spot accumulation is not appropriate right now, the derivatives market is providing significant opportunity. The signal is clear, the trend is still downward. If the direction is down, then we continue shorting. There is no need to overcomplicate it. Short on rallies, short on breaks of support, short when each key level is taken out. You don't even have to restrict yourself to the largest assets. You can short other tokens within the top 20 by market capitalization. In many cases, the directional movement will not differ dramatically. If you're concerned about selecting a token that unexpectedly moves against the trend, then stick to Bitcoin and Ethereum. Now let's talk about another token today, one you're very familiar with, Justin Sun's Tron. Tron has always been controversial. Its ecosystem has not been particularly vibrant. Whether in DeFi, mini-app ecosystems, or NFTs, it has never been especially dominant. It has remained relatively subdued. However, in one area, it is absolutely dominant: stablecoin settlement and payments. As I've mentioned before, if you don't fully understand the broader crypto space, there are 2 segments you can focus on. First, exchanges, particularly exchange platform tokens. Second, stablecoins. These 2 sectors have the most direct real-world usage and the strongest integration with traditional finance. In my view, stablecoins may ultimately have greater practical application in a future AI-driven economy than most other crypto assets. At least based on current trajectories, their utility appears far more immediate and scalable. Tron has quietly maintained relevance because of this. Many investors may not pay attention to it, some even hold personal bias against Justin Sun himself, and as a result, they overlook the project. But from a structural standpoint, its role in stablecoin infrastructure is significant. However, Tron has quietly maintained an overall upward trend. Even during this broader market decline, it has not fallen back into the prior major consolidation range. Compared to Bitcoin and Ethereum, it has shown relative strength. Yes, it has pulled back, but the pullback looks more like consolidation rather than structural breakdown. Recently, price dropped to the 0.27 support area and essentially stabilized there. Now, could it fall further? Of course, 0.27 is not an exact number, it's a zone. So, is it possible that price dips further, perhaps towards 0.26, the lower boundary of the previous discussion range, or even toward the midline of that prior range around 0.23? I believe those would be reasonable accumulation areas for spot positioning. Personally, I see Tron as a strong candidate within a future AI-driven economic environment. That said, it has not yet reached the optimal entry level. And this ties back to what we discussed earlier. When shorting in this environment, you should avoid shorting relatively strong assets like this one. Instead, wait for deeper pullbacks and then accumulate spot positions. That's the core strategy for today. Overall, not much has changed. The market is still oscillating within a range. Whether you interpret it as a box range or a symmetrical triangle, remember this: the fundamentals do not support going long right now. So the strategy remains short, short, and short. The macro and liquidity conditions have not shifted yet. If one day you suddenly see a massive bullish candle, a sharp breakout upward, and price spikes aggressively, you can come back and tell me I was wrong. But the moment you say I was wrong, I will open a heavy short position. Because a vertical spike in this environment would represent opportunity, not confirmation of a new bull market. I will not assume that confidence has returned. I will not trade emotionally. The fundamentals do not support that kind of sentiment-driven buying. We must trade rationally. So the directional bias remains unchanged. That's all for today's analysis. If you're interested, follow the channel. We share actionable signals regularly. See you next time.